market, the stocks are in some ways the best protector against inflation. So that's the argument for staying invested in the long run. But then do it in a resilient way. And I think healthcare is a great example of that. Healthcare has been a very positive long-term compounder. Why? Because we're aging as a society. As we age, we require more healthcare. So the long-term demand is there. This sector is very resilient in recessions. The earnings tend to still rise even in recessions. And then you look at valuations. The valuations are quite reasonable. Healthcare trades at a below market multiple, despite all those great characteristics I just described. So it's a great fishing pond.
Tony, the other side of things as well is energy and financials. When someone hears someone talk up the potential of recession and then follow it up with energy and financials, are we going to trade on growth slowing down, on inflation remaining sticky, or both simultaneously?
Yeah, there are a lot of cross currents right now, and I think that's one of the advantages of trying to stay balanced within your portfolio. And so think about energy. Well, first of all, energy is a global market, and we have China reopening right now. So that's going to be boosting demand. We also need to refill at some point the Strategic Petroleum Reserve, and then there are geopolitical risks. At the same time, supply is very constrained. Particularly if you look at what's going on in shale, it's very interesting. What you're seeing is companies all raising their capex, but not raising their production guidance. Why? Because they've drilled the best wells already, the best acreage, and now they're going to that second tier. So productivity in shale is falling. I think that's really interesting and spells very good things when you think about supply demand. We've got these nice demand boosts, and at the same time, supply is still very constrained.
That raises a question, though, Tony. Do I want to be long the commodity, the underlying commodity, or the energy producer itself, the company?
Yeah, so go back to valuations. Great question, right? Multiples on the energy sector actually contracted last year, despite it being a very robust year for the energy sector. The favorite part of the energy sector for me is actually European, particularly UK integrateds. They trade at a sharp discount to the U.S. integrateds. A lot of that's driven by shareholder preferences when it comes to ESG, but what we're seeing increasingly is U.S. shareholders are buying into those companies, and so we've seen that valuation gap start to narrow this year, yet there's still a long way to go. And so I think that's a great way of both finding resiliency and upside.
Do they deserve to trade at a discount because of the fiscal issues as well, the windfall taxes we see across Europe?
Yeah, so those windfall taxes, they're big headlines, but in terms of the impact on their earnings, quite small. It only applies to the oil that's actually drilled in those countries. It doesn't apply to all of their earnings. And so the impact is very tiny. And yeah, I do agree they deserve to trade at a discount, but nowhere near the discount they're trading at today.
Tony Smart, as always, great to get your thoughts on this market. Tony DeSpirito there of BlackRock, breaking things down for you. Resilience, look to healthcare, fight inflation, financials, energy. That's the call from the team at BlackRock on the equity side of things. Right now for equities, 12 minutes in, firmer, higher by 0.5% on the S&P. The Nasdaq firmer, higher, positive by 0.6%. Coming up on this program, more layoffs on Wall Street.
There's a few areas like in tech and things like that where there's sort of layoffs and a little bit in financial services, but generally the labour market's in pretty good shape.
That conversation next.
The labour force might have a little bit more confidence. There's a few areas like in tech and things like that where there's sort of layoffs and a little bit in financial services, but generally the labour market's in pretty good shape. So consumers feeling confident in their jobs, coupled with reasonably high levels of savings, certainly in the middle and higher income portions of society, that can continue to sort of drive a robust consumption story.
Job cuts spreading on Wall Street and making their way to Citigroup, the firm laying off hundreds of employees, including staffers from their investment banking division. Sonali Basak on top of the story. Hey, Sonali.
John, this isn't a consequence of the boom-bust cycle just yet, because when you watch the headcount reductions, you're seeing it in the hundreds, not the thousands like we're seeing over at Goldman Sachs. And even when I pressed Goldman Sachs about further job cuts, they did not quite bite. So what are we looking at Citigroup here? This is another cut that amounts to the hundreds, less than 1% of the company's workforce. However, of course, these kinds of drip-by-drip headcount reductions causes a tremendous amount of anxiety and strain across the street. Of course, this comes weeks after we recently reported that Bank of America is also doing the same. This is largely in the investment banking divisions where activity has been very, very muted. Now, remember, there's this hope, this grand hope, that things will start to turn around by the second half of this year. Of course, that's highly contingent on a lot of things. Nothing going wrong, as well as the rate story starting to stabilize, John. The banks are still stuck with lots of hung debt, which really constrains them moving forward in some of the activity that they're looking forward to. But remember, this isn't a wholesale headcount reduction. There is still hiring, but in kind of more boring places. Remember, for Citigroup's stake, for example, that is places like compliance, as they have to deal with consent orders, and technology, as big banks look to get ahead of the future as they look through the storm.
Sonali, we talked a lot about excess hiring in tech. Can we just talk about excess hiring, Sonali, at some of these big banks in just the mortgage parts of the business, offering mortgages? I was looking at the average mortgage rate in the United States. It's back through 650 on a 30-year fix. It's approaching 7% all over again. Sonali, I just imagine there's a lot of people sitting on their hands. There's just no business right now because nobody wants those mortgages close to 7%.
The bigger problem, too, John, is not even just right now that structural issue in the market about the mortgage rates. It's the pricing of housing as well, the shift towards rental housing, and the private equity and institutional entrance into these businesses. Where do the banks then play? Do they have to make larger structural changes to those businesses? Of course, JP Morgan, Wells Fargo, Citigroup are already cutting in the mortgage markets, but are there much bigger shifts ahead? History would say so.
Sonali, thank you. On the cuts at Citi, really small, insignificant to the total pool of workers at Citi, but of course this is always very, very personal for a lot of people, so I thought it with them as well. I want to talk about the economic data so far this week. We had an ISM earlier this week. It was ISM manufacturing, and it wasn't the headline of the index that got everyone's attention. It was the prices paid component of it, elevated. Sticky inflation, anything that speaks to that right now has spooked this bond market. Today, we get ISM services in about 11, 12 minutes from now. Mike McKee's going to break that down. Mike, this is almost like the appetizer before the big one, right?
Yeah, it's the S&P Global US PMI for services and composite. It's sort of the little brother to the ISMs, and it comes in at 50.6, up from 50.5. So a little more strength, and it doesn't suggest that we fall back. The number of the ISM last month was very strong, and there is some thought that it would come back a little bit. Composite for the S&P Global 50.1, that's a little bit lower. And in Europe, we got a lot of the services PMIs out today, and the one thing they all have in common is they all cross 50. So we are seeing strength in services around the world. So the question becomes, what happens at 10 o'clock Wall Street time to the ISM services number, that big jump we saw in January? Does it follow through into February?
Mike, talk to me about the difference between the S&P Global PMI and what we get from the ISM and the traditional spread between the two, perhaps. Which one do you follow most?
Well, we tend to follow the ISM much more, particularly the manufacturing one, because it's been around since the 1930s. The services numbers just started coming out in the 1990s, and they're a little bit different because of the size of service industries, but in general, ISM has bigger, more established companies that do business mostly in the United States, whereas the S&P Global has smaller and often more export-oriented producers. So probably the combination of the two gives you an idea of what's going on, but it's the long time series that Wall Street likes about ISM.
Mike, you went through the calendar for the next couple of weeks. So we get the ISM in about 10 minutes. Chairman Powell speaks tomorrow, March 10th, payrolls, March 14th, CPI. If there was a speech written, testimony already for Chairman Powell for next week in front of the Senate and the House, do you think that could get edited if this is really strong in 9 minutes?
I don't think it would be unless the prices paid went up significantly, but I think the message is going to be the same as it has been. He's going to come out and say higher for longer. We're going to raise rates again, and we're going to keep them there that way, and we are absolutely committed to bringing inflation down to 2%. Given the fact that those other big indicators are still out there after he testifies, I think he's going to be careful about going too far predicting what will happen at the March meeting or beyond.
Mike McKee, thank you, sir. 8 minutes away from that data here in the United States, the ISM Services Index. Mike, Alex Steele, Guy Johnson, they're going to break that down for you in about 8 or 9 minutes' time. I went through the calendar. I'll repeat the dates for you. Chairman Powell next week, and then it's on to payrolls on Friday, the following Friday, of course, March 10th, and then March 14th is when we get that next CPI read, and on the 22nd, the Federal Reserve meets to decide where interest rates will be and where they should be, and ultimately the summary of economic projections comes out too, so we get another round of forecasts from the Fed, and that's where potentially the fireworks might be. The broader market right now, 22 minutes into the session, positive 0.5% on the S&P, on the Nasdaq up by 8 or 9/10%. To lift the lid on the index, let's get you some sector price action. Here's Katie.
Hey, John. Well, we are looking at a little bit of a rally on the broad index level. Let's break it down and look at what is driving it. You have real estate up on the day, leading the charge, up over 1%. Communication services, I often think of that as big tech, and it is Meta that's leading the gains there. So a lot to like, 9 sectors in the green. You look at what isn't doing too well, it's energy, off by just a hair, and at the bottom there is consumer staples, off by 0.6%. A lot of those losses coming from Costco, which we discussed earlier. And if you look on the week, the S&P 500 is set to squeak out a gain. What's doing really well is materials. That's up to almost 3% over the past 5 days, and industrials up over 2%. That's typically good news for an equity rally, and it's not on the board, but utilities not doing too great this week, John, and a lot of that is rate pressure.
Katie, thank you, and looking forward to the show a little bit later. Real Yield with Katie Greifeld about 1 p.m. Eastern Time. Look out for that. Bonds going into the ISM, rallying. Your 10-year down 7 basis points. Your yield just south of 4%. Your 2-year down 2 basis points. Your yield 4.86. Up next, your trading diary.
At that all day yesterday.
25 minutes into the session, equities up by 0.75% on the S&P, advancing on the Nasdaq by a little more than 1 full percentage point. Equities up and yields come in just a little bit. Going into this, here's your trading diary. ISM Services at the top of the hour. That is the data point of today. Another round of Fed speak. Logan, Bostic, Bowman, Barkin all on deck. President Biden greeting German Chancellor Olaf Scholz at the White House this afternoon. Looking to next week, it's Chairman Powell on Capitol Hill for 2 days of testimony. And finally, we get the US payrolls report next Friday. I can tell you right now, moving target, but in our survey at the moment, the median estimate 200,000. The previous number, as you're well accustomed to right now, 517,000, because we've been talking about that week after week, day after day for the last month or so. That does it for me. Have a wonderful weekend. This was the Countdown to the Open, and this is Bloomberg TV.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, March 3rd. Here are the top market stories that we're following for you at this hour. Cash, as good as it gets. Bank of America says cash is just as good as stocks and bonds until the bear market ends. Equities jump higher, led by big tech. And new crackdown on China. U.S. slaps export curbs on dozens of Chinese entities ahead of President Biden's meeting with German Chancellor Olaf Scholz, raising those stakes. And restaurants, vacations, and shopping. ISM Services breaking right now. Will it show if the economy is reaccelerating? From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Well, Guy, what you got?
not maybe re-accelerating, but maybe not decelerating either. The service sector continues to deliver. The headline number, the services index, ISM, 55.2, the prior number 55.1. This number, i.e. no move. The market was looking for 54.5, i.e. we are above expectations. Prices paid dips a little bit, but I think probably within the plus or minus. Employment rises to 54. That's a strong piece of data that you want to pay attention to, and look at new orders. They pop higher as well. 62.6 up from 60.4. It's a similar story over here on this side of the Atlantic. Excuse the German data today on services in the PMIs, and you see a similar trend as well. The final numbers on the last round of data just ticking even higher. Alex, it's amazing to see what is happening here. Mike McKee, what do you make of this? Our question of the day, we're going to talk about it in just a moment, is re-accelerating in the services sector. Is this what this is?
It appears to be. It appears to be the services sector doing quite well. Americans spending money in that category. Also interesting that it's happening around the world, even with Germany. In the PMIs in Europe, all were above 50 for services. You look at the new orders, as you mentioned, 62.6. That probably tells us the most about where we're going. Plus, the employment one brings up an interesting question. Employment went up. We'll find out more when we get to the jobs report a week from today. But does that suggest that people in service industries are finding the employees that they need to find, and that maybe then hiring will start to slow? That's something to keep an eye on. And of course, prices being the thing that everybody is watching, particularly the Fed. The fact that that doesn't really change very much is also a warning signal that at the beginning of February, at least, looks like what we saw in January.
Hey, Mike, before we get to the question of the day, do we know where in services things are super strong?
Haven't gotten that far in terms of a breakdown, but it does appear that we're seeing commodities, there are commodities in the service industries up in price much more than down in price. So things that go into the services, labor services, they say, and that's going to be something that the Fed is watching.
Really interesting. Mike, hang tight with us. We want to bring in the question of the day. Guy just alluded to it, but forget the landing. Our services taken off. So Kriti Gupta is going to join the conversation now. Kriti, looking through the numbers, looking through how markets and investors are positioned. What do you think?
Well, yes, is the answer to the question of the day. They absolutely are, and I think this really adds fuel to the fire of that no landing scenario that Torsten Slok initially coined. You can kind of almost see that in the yield picture, the two-year yield really spiking here, 489, getting closer and closer to that 5% level. One of the issues here with the services taking off is simply the idea of, well, a no landing scenario does not mean things are all in the clear. It means that you have to revisit the story of inflation down the road. There's that reacceleration built into that argument. In 2023, perhaps not as much. In 2024, 2025, yes. How do you price that in? That seems to be the question. And right now, the equity market is really struggling with that because they're not pricing in that far out. The bond market far more clear about just how hawkish the Federal Reserve may have to be to tackle a no landing scenario.
Yields have been tracking lower throughout the day, certainly on the two. You can see on the screen right now they're beginning to certainly track the other direction, in the other direction. Mike, is the Fed in control of what is happening in the services sector right now? I keep looking at the numbers and they keep surprising on the upside. This is a sector that feels like it's accelerating. It's a big part of the U.S. economy, and it feels immune at this point to Fed action.
Well, it is not responding to the Fed yet, at least not enough that will make a difference to the economy. Now, if you think about it, you go back to a year ago when rates were at zero. March 16th was the first rate increase. Do you think we are at restrictive yet? The Fed doesn't think so, which is why they are talking about raising rates further. So basically all you've done is remove accommodation. You haven't tightened it, and so people are at this point they still have money, they're still spending, and that makes the case for the Fed to go higher. How much higher do they have to go? We'll have to see.
It also goes to show that January's positive data wasn't a fluke. It wasn't like one good piece of data, but then we're going to continue to slow down. That is apparently not the case. So Kriti, it also raises the question that Guy and I were talking about earlier when we were making our editorial decisions. Like, is the market telling the Fed that they're behind the curve, like, again? Like, they're behind the curve said they caught up, and then now if we're looking at 6%, say, Fed funds rate, are they behind the curve?
They could be, and I think that's where the jury's still out, especially for this March 22nd meeting. We have a lot of hot data as we're dealing with. That's bringing back the question, I think you asked earlier this week, is 50 basis points back on the table? And I think this is a really big question, because if you start to see the Federal Reserve say, well, actually, we are data dependent, and we are seeing some of that information, or some of that data, come out extremely strong, then yes, we do have to go much, much harder on inflation, and then we truly are data dependent. The problem here is that credibility issue that you just bring up. Do we start to see a behind the curve idea that the initial phase of tightening wasn't enough, which then again asks questions, does the Fed know what they're doing this time around? You also have to factor in, though, that a lot of this isn't necessarily a strong consumer or a strong business environment. It's also the fact that some of the issues that were kind of impeding liquidity for a lot of these companies, I don't mean market liquidity, but liquidity in terms of resources, that was already coming down. Right. Supply chain issues, labor, things like that. Those are less so issues, inventory even, and you're seeing that on the earnings calls this time around.
Okay, so what do we get, Kriti, from the corporate earnings season in terms of supporting or going against the idea that services are taking off? It was interesting, Torsten Slok, you mentioned him a little bit earlier on from Apollo, out with another note first thing this morning, talking about the fact that occupancy rates in hotels are rising and are continuing to rise, and he sees revenue per room continuing to rise. That I would have thought would be a useful indicator coming out of what is happening with the hotel sector, telling us that maybe things are accelerating. You look at what's happening with the airlines. Lufthansa are out with numbers today, upgrading its forecast. What did the corporates tell us about the service sector?
Well, it's telling you that the inflationary story is really kind of panning out into a wealth effect, essentially. The idea that maybe 6 months ago, groceries were really, really expensive. I promise this all connects, guys. Stick with me. Groceries are really, really expensive. 6 months later, they're still expensive. They're a little less so. And they are seeing that decline. I can speak anecdotally. You are seeing that decline in budgets. But the other piece of the equation is that prices are coming down as well. But that margin increase that a lot of companies have put forward and have actually been rewarded for in the stock market hasn't necessarily panned out for every company. I'll give you an example. Costco, for example, reporting after the bell yesterday, getting punished in the stock market today. And a lot of the analysts say, well, it's because they didn't have a membership hike. They had great profits. They had great sales. They should have really kind of capitalized on that by increasing their membership fee, and they simply didn't. For our international audience, this is a warehouse kind of a grocer, retailer, essentially, that you have to get a membership for to get access to buying goods in bulk, and that's why Costco shares were punished. So I think the story here is that the consumer is going to get stronger, not necessarily as a whole, but respective to or relative to how they were in 2022, and therefore, are companies going to take advantage? We don't know.
Yes, and Costco sells alcohol different than BJ's, which is key when it comes to those memberships and buying in bulk. Hey, Mike, this feels like a really tough report, if you go back to the ISM services, for Jay Powell's setup into his biannual testimony next week to Congress. How does he talk about this?
He probably talks about it in the context of the fact that the Fed has only removed a combination. They haven't really gotten too restrictive yet, and that it takes time, the long and variable lags argument, and that's why the Fed is going to not just raise rates, but keep them high for a while to try to soften things up. Ironically, it might help him a little bit because we know going in he's likely to get a hard time from people like Elizabeth Warren, who worry the Fed is going to send us into recession and we will lose lots of jobs. And he can say, well, look, you know, we've gone up 475 basis points and we're still seeing a very tight labor market. We're still seeing hiring. So it doesn't look like we're going to go into recession anytime soon.
Yeah, fair enough. I'm also looking at the whisper number for the job data next week, 213,000. I bet you that gets revised up real fast for the whisper number. Guys, thanks a lot. Great. Thanks for breaking this down for us, Michael McKee and Kriti Gupta. All right, some other breaking news for you that comes from Amazon. Amazon is now pausing construction on its second headquarters near Washington. Now, this comes as the company's also looking at its deepest job cuts ever and a reassessment of their office space in the middle of remote work. We're going to get more on the story in just a moment. Amazon stock still up by 1.6%, one of the top gainers within the S&P, but they are pausing construction, their second headquarters in Virginia. All right, coming up, more on our question of the day. Forget the Landon. Our service is taken off. Alexander Wilson Alonso of Goldman Sachs Asset Management joins us next. This is Bloomberg.
Exclusive Monday. J.P. Morgan Chase CEO Jamie Dimon sits down with Bloomberg's Ed Hammond. Live from the J.P. Morgan Global High Yield and Leveraged Finance Conference in Miami. Only on Bloomberg TV and radio.
All right, markets really moving here. We have the NASDAQ kind of off the highs. We have yields continuing, although I should say the yields are definitely moving lower as some buying now coming in. We got that pretty hot high SM services number, though, which raises the question, forget the landing and our services taking off. Joining us now with her take is Alexander Wilson Alonso, co-head of portfolio management for multi-asset solutions at Goldman Sachs Asset Management. These numbers are really strong. New orders really strong. Employment strong. Prices paid coming down a little bit. Overall, you're looking at 55.1. Are we taking off?
Yeah, you're right. Recent data has been pointing to inflation drivers being alive and well, but we do not think that this is a regime change in terms of inflation. We're very much so focused on the fact that we've just gotten to tighter conditions. If you're using something like core PCE versus Fed funds, we're pretty much at the equivalent rate at this point. And labor is a lagging indicator. So it's going to take some time. This disinflationary story is going to be bumpy. But when you look under the hood, you are seeing some real signs that higher rates are starting to impact things. So when you look at senior loan officer surveys, 45% are saying that they have tightened lending conditions and demand is actually down. If you look at small businesses, you're seeing that their payrolls are coming down. And one of the most important things that's driving services is wages and wage inflation. And we're seeing signs, in the non-traditional indicators that churn is also down. So next week, one of the things we're going to be paying a lot of attention to is JOLTS and quits rates to see if that's the case. But from our perspective, this is not an inflationary regime change.
Alexander, when is the equity market going to see the negatives, though? At the moment, the glass feels very much half full from an equity market point of view. Yes, it's come down a little bit, but we haven't had the kind of really big aggressive sell-off. And in fact, the beginning of this year has been really quite positive. Barclays out with the note, Emmanuel Cao earlier saying, basically, the market can cope with these kinds of rates because the market is focusing on the growth side of the ledger. And the growth side of the ledger is outweighing at the moment the higher rates. When does that relationship flip?
Yeah, it's a great question. We also think that equities are trading more towards spot growth data, more present in the information that's coming in that's positive. Typically, you see in harder times and recessionary conditions that equities don't turn until after you hit the official recessionary pivot point. And so we could have some time. And honestly, technicals are in the favor of equities right now because we know people didn't come into the market long this year. And there could still be some pretty strong momentum. But to your point, 18 times forward earnings on a cyclical adjusted basis isn't tremendously attractive. Right. It's, for us, we're trying to find the places where there's a lot of dispersion. The micro stories are taking place. And we think that active management's really going to add some value there. And when you think about higher cost of capital, higher cost of funding, the consumer also changing the way that they're spending, there are going to be those stories that start to pop up. And in fact, we saw some of them this week. And so we're really focused on dispersion and finding the alpha rather than the beta in the U.S. equity market.
From a total allocation perspective, though, Bank of America was saying, look, cash is just as good as stocks and bonds. Do you agree?
To some extent. So cash is a really decent barbell to portfolios. 5.5% yields is very attractive, but you don't have the duration pull that you get when you go out on the curve. And from our perspective, duration is attractive. We think that 4% all-in yields, on the 10-year is a great place to be. You have like a 60 basis point break even in order to lose money if you were to invest in the 10-year. And we think the bar is pretty high for the Fed to start going from 25 to 50. With the main driver being, if you look at inflation swaps, one-year swaps, they're around 2.5, meaning the Fed has credibility. The market's underwriting the Fed still. You start moving to 50 basis points, it could be a sign of panic that, okay, we don't have inflation under control. We are behind the curve. And we think that that's going to keep them reined in a little bit. Relying on that, it takes time. We're going to be higher for a longer story.
Alexander, what about bonds versus credit? Where do you stand on that? Because there is certainly a risk that we see, particularly at the bottom end of the credit market, defaults starting to rise, problems starting to emerge. How are you playing that one?
You are starting to see some signs. In particular, triple Cs are outperforming the market, and that's a pretty low quality rally from our perspective given where we are in the cycle. And we are seeing some downgrades start to pick up pace. That being said, credit markets, the corporate America is in a pretty decent spot. They spent the better part of COVID, post-COVID, effectively reconstructing their balance sheets. But we do think from an upside perspective, it's capped. So if you get a decline in yields or spreads decline, you're going to get a lot of corporate America coming to the credit market trying to refinance themselves, or at least trying to do some sort of activity. So from an all-in yield perspective, there's a lot of buffer should spreads widen out a little bit, but we do think that there's going to be a more attractive entry point into credit.
So you mentioned equity still being a little bit too expensive, and you have to be really judicious about where to go. I continue to be confused about technology. I'm looking at the NASDAQ 100, it's still up 1%. Meta seeing a nice rally here, up 4%. I mean, how does that make sense to you? Like, where in tech can you actually find good value?
I think what we're seeing is, tech is getting grouped in with growth, quote unquote, if you will, but there's a lot of quality. There's good balance sheet. There's a lot of cash. There's the ability to still do M&A and strong activities. And so, again, we're really focused on there are some strong, solid micro stories, and it's less, hey, let's buy the index.
Right. Yeah. Okay. Interesting stuff. We'll talk tech in just a second also. Alexander Wilson Elizondo, co-head of portfolio management for multi-asset solutions at Goldman Sachs Asset Management. Thank you very much. Great to see you. So still ahead, talking about Amazon cutting jobs. We knew it was doing that, but now it's pausing construction on a second headquarters in Virginia. We're going to have more details on that next in The Startup. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The CEO of Barclays is in remission after being treated for non-Hodgkin lymphoma. That's according to a statement from the London-based bank. CS Venkatesan Krishnan said in a letter to staff he plans to be working more from the office over the coming weeks. In the UK, the markets regulator is investigating the London Metals Exchange. The issue is how the LME handled a massive short squeeze in the nickel market last year. Nickel prices spiked 250% in a little more than 24 hours in March. The LME suspended the market for a week and cancelled billions of dollars of trades at the highest prices. And Bloomberg's learned that Amazon is pausing construction on its sprawling second headquarters near Washington, D.C. That coincides with the company's biggest job cuts ever and a reassessment of office needs to account for remote work. The first phase of the campus in Arlington, Virginia, that Amazon calls HQ2, is nearing completion. It's the larger phase that's been put on hold. And that is your latest Business Flash, Guy.
Rebecca, thank you very much indeed. 22 minutes past 7 on the West Coast. This is what it looks like. A little more overcast than yesterday. So let's get to the startup where we cover all the top tech stories from the Bay Area and beyond. Silicon Valley starting its overcast morning. Joining us now, Bloomberg Technology Co-anchor Ed Ludlow. Ed, Rebecca just mentioning it. Talk us through this Amazon story. Talk us about whether or not this is a surprise.
Yeah, well, I'm looking at the stock movement as well, like a little bit of a delay or latency, but the stock kind of really pushing higher now. Is it a surprise? Well, what we know is that when the local authorities approved this phase of planning permission, according to a Bloomberg source, Amazon was keen at that time actually just to get going, shovels in the ground, and was considering digging into the foundations as early as last April when that vote took place. Then what we know is that when that didn't happen, they considered starting this phase of construction in the first early months of 2023. So it does seem like this is a pivot. What has changed in that time, of course, is the announcement of Amazon laying off 18,000 workers, which is its deepest cuts in history. And, you know, combine that with the stock cheering this news, it seems, again, another piece of sort of financial prudence. But it's a really interesting one because it pushes back the timeline for what is a firm commitment from Amazon.
So I also have to wonder, Ed, how much of this is maybe not finding the right labor or the right kind of supplies. Like, I appreciate that they're rethinking their office space. I appreciate that they're cutting jobs. But, like, building something is obviously different than, like, workers in a warehouse. Do we know how much of this is impacting decisions?
Well, so the first phase of many is basically almost completed out in Arlington, Virginia. And if you read the Bloomberg reporting, Amazon's actually close to moving in a high number of people into that first phase of buildings pretty soon this year. June, I think, is the target. This is the much bigger phase. And to give you a sense of scale, it is 3 22-story 22-story towers, 350 feet tall, helix, a corporate conference center, an indoor garden, plant-filled orbs, basically similar, you know, it's something similar to the plant-filled orbs in Seattle. It's a major project, and, you know, I think the idea is that it's a 2030 project, which is now being pushed out even more distantly.
Is it just Virginia? What's happening in Washington? What's happening elsewhere? They've also got other sites that they've been pushing too. I appreciate maybe not as big as this, but is this a kind of complete clampdown on building elsewhere outside of kind of Seattle, etc.?
Well, the first phase that I was talking about, moving those employees into new facilities, does include the facility near the Pentagon, for example. You know, I think what Amazon is doing as well is making pretty targeted cuts. So at the same time, you know, what we've discussed in our reporting is AWS, for example, not seeing as deeper cuts. Areas like marketing, HR, and the devices business have. And the real estate that Amazon's working on kind of corresponds to different business areas. So it depends where they're cutting back as much as where they're moving forward.
Hey, Ed, before we let you go, why is tech up right now?
Why is tech up right now?
Yeah.
It's Friday.
Why is Meta
Happy
up 4%?
Friday. Look, there's no sort of reason or rhyme in the market right now. I think it's interesting to see Tesla higher, for example, based on the China data that came out overnight. Dell responded to its earnings pretty negatively in terms of sort of a tepid forecast for the current quarter. It's now higher as well. You know, there's some choppy trading going on. I think that the market's shrugging off the data as well. You know, we're still in this phase where good data, bad news for the markets because of the Fed, and tech is caught up in that. And wasn't your last guest just talking about how tech is just lumped in with growth at the moment anyway?
Fair enough. All right, Ed, good stuff. Looking forward to your show tonight as well. Bloomberg Technology co-anchor Ed Ludlow. Coming up, President Biden and German Chancellor Olaf Scholz will meet later at the White House. Weapon supplies to Ukraine top of the agenda. We're going to take a look at what it means with Terry Haynes. This is Bloomberg.
One, this will fight the critical minerals, what they call monopoly China has, but also potentially it gives them access in some of these green subsidies from the IRA. And we all know that Europe was really up in arms with the IRA.
Yeah, language being toned down a little bit, but I think there's an acceptance now that the IRA, the IRA as they call it in Brussels, is now real. Anne-Marie, thank you very much indeed. Bloomberg's Anne-Marie Hordern joining us from the White House. The Chancellor, Olaf Scholz, will be arriving a little bit later. We're joined now by Terry Haynes, founder of Pangea Policy, a Washington think tank, to discuss this trip and what else is going on in D.C. Terry, let me ask you the same question I just put to AMH. Why such a low-profile trip from the German Chancellor?
Well, I think they really want to do two things. One, they want to show that there is allied agreement, continued allied agreement on the broad strategies and the goals of Ukraine engagement, but they need to get down to brass tacks on some of the specific tactics, and that's largely what this meeting is about. What Biden wants to come out of this with, and I think what Scholz wants to come out of this with, is a meeting of the minds on tactics. Exactly, what specific steps are going to be done, when they're going to be, when and how they're going to be done, who's committing to what. So, you're seeing, in essence, a ramping up and a tightening of the Western alliance here, and that's, I think, what they both want to achieve.
How does China and the worry that China will be supplying its own weapons to Russia play into this? Like, is there going to be a unified front on how to manage that?
Well, my view of this, Alex, is that this is a increased geopolitical risk net, which is not a market positive. I don't think it's a big negative. Everybody understands what's going on in the broad strokes. But what you're going to get is a successful meeting between the United States and Germany, and then you're going to get some response in rhetoric from Russia, response in rhetoric from China that will keep everything kind of on the simmer, but a little bit more definitively so. And so I think what ends up happening here is that the red lines, as the White House decides to call them once again, end up getting even more well defined.
Terry, the general election is coming. There is genuine fear in Europe about the US's commitments post-election to the war in Ukraine, whether or not there will be a continuation of the kind of weapon supplies that we've seen thus far and the support that has been delivered. Is this meeting really about the fact that these countries now know that they're on the clock? As you say, they need to get down to brass tacks. They need to get this done. This whole idea that this conflict could stretch on for years and years and years is not politically palatable on either side of the Atlantic.
No, it's not politically palatable, but the fears that you describe Europe having about the United States has about Europe. From my Washington vantage point, anyway, I see virtual unanimity on China and on Ukraine policy. There are people that are kind of picking on the margins, but there's no serious effort to try to roll back Ukraine policy in the United States. What they need to do in the short term, Biden and Scholz, is agree on the exact next steps. Are we doing ammunition? If so, how much? Are we manufacturing? Are we doing tanks? Are we doing this? Are we doing that? And the broader and the longer term, exactly what is it that we're going to commit to. That medium and longer term is, you're absolutely right, is hazy. It will remain hazy for some time, and not just because of the 24 election.
So does the ammunition manufacturing get highlighted here in the U.S.? Like, isn't Europe having a lot of problems sort of delivering? Is that what we're going to also see?
Yeah, sure, but there's going to have to be a joint commitment, and I think there will be to ramping up the materiel, not just of ammunition, but of a variety of kinds that are provided to the Ukrainians. And I think there will be a lot of discussion about tanks, which the United States has committed but not committed in the short term, kind of exactly what the material needs of the Ukrainians are, and a discussion about the ability of the Western allies to match it. So that's a pretty serious conversation, and I suspect Biden and Scholz will be having it today.
Terry, do the American people care about this conflict deeply enough to continue the kind of support that we've seen thus far? There has been significant criticism of the president, the White House, this administration in terms of its handling of the recent toxic spill. But there are other cases similar to this, obviously not as harmful, but nevertheless, is there a danger that the American people ask the president to refocus his attention back on what they need?
Well, I think the two things, Guy. I think that question is very well stated. But I think there's two things here. I think, firstly, the vast majority of the American public support Ukraine. Secondly, and support the Ukraine policy. Secondly, the administration, I think, takes somewhat for granted its need to explain and continue to convince the American public of that. Because if they don't do that, and they don't also take care of domestic items like the Ohio disaster that you mentioned, clearly the American public's going to conclude that the administration overall either isn't up to snuff or has its priorities in the wrong place. So there's going to need to be a muscular and I think more energetic explanation role that's needed.
It's such a good point, and this has been the problem kind of all along, the communication of like what they're doing versus what they're actually saying. What do you make of how they've handled the train and toxic chemical spill? And I know that that's not where our audience is in terms of markets and focus, but it does feel like it's going to sort of move the focus around. It draws different questions as to like them being able to get stuff done.
Well, look, the Ohio spill is a real disaster, first of all, real disaster. And I don't want to make light of that a bit. But the second time, secondly, it's a political disaster, though. Yeah. I'm not in favor of kind of facile similes, but this is veering very close to the terrific job brownie kind of business that happened in the second George W. Bush administration, and the administration doesn't seem to have a political handle on it, and doesn't seem real interested in getting one either, and that's unfortunate for them.
If the administration doesn't get a handle on what's happening domestically, and the American people do consider the fact that maybe priorities are misaligned, does it undermine America's ability to deal with China, for instance?
Well, I think what's different here is that there's a great difference in opinion about how the Ohio spill and how a variety of domestic issues ought to be dealt with. On the national stage, including senators and representatives, there's little to no disagreement. In fact, what you see in Congress now, from the last Congress, say 2022 to this Congress, I think is striking. You had last Congress taking a year and a half to pass the China legislation that turned into the CHIPS Act. Now what you've got half dozen pieces of legislation moving at speed to do a variety of things on top of the Biden administration's regulatory and sanctions work. So things have changed a great deal, but I think that unanimity on understanding what the foreign policy priorities are make Ukraine a very different kind of circumstance than some of the domestic issues.
Really great insight, Terry. Thanks a lot for hanging out with us. Terry Haynes, a Pangea policy founder. Thank you very much. All right, coming up, we're going to tell you about the ETF that bets that a well-known stock picker will get it wrong. It's the anti-Jim Cramer ETF. It's a pretty great story. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. The US and South Korea are planning to hold large-scale military drills later this month. Those exercises are certain to anger North Korea, which has threatened to unleash an unprecedented response. US and South Korean defense officials say the drills will bolster a, quote, joint defense posture in the face of North Korea's nuclear and missile threat. The US is warning companies against doing business with those trying to evade sanctions on Russia. The Commerce Department says businesses should watch for transshipment points where goods are legally purchased but then sent on to Russia or Belarus. Those locations include China, Macau, and countries close to Russia such as Turkey and Armenia. In Hong Kong, fire raced through a 42-story hotel being built near the waterfront. It took hours for it to be put under control. There were no casualties. The Kimpton Hong Kong is a 492-room luxury hotel that will be operated by Intercontinental Hotels Group. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thanks a lot. So it's ETF Friday. It's been quite a couple months to start the year. Bank of America has a note out that says the cash is back in vogue. It's just as good as stocks and bonds. So we wanted to get to the flows with Bloomberg's Katie Greifeld. Katie, do the flows back that up?
It's nice because the flows make a lot of sense if you look over the past month. Let's look at where money is leaving, because it's leaving sort of those big index tracking funds. You have SPY up at the top. Over the past month, it's seen almost $18 billion exit. That is a lot. Then you look down the list, it's HYG, it's LQD. So even credit is getting in on the action in terms of people are just offloading those credit funds. What they're going into is exactly what you said. It's cash. I think it's really telling that if you look over the past month, the top two funds are very short-dated Treasury bill funds. It's 0 to 6 months, 0 to 1 year, that sort of variety. And it makes sense. I mean, we've all been talking about it for a month now, is that if you can get a 6-month Treasury bill at 5%, and then you look at what is happening in the equity market, that looks pretty good right now. It's an attractive place to hang out.
Yeah. Katie, a few weeks ago, we talked about a new ETF which was tracking Congress and what it was doing in terms of its investment strategy, congressional leaders. Now we have the Jim Cramer ETFs, and this is a positive and a negative. What do we know about this?
So this is great for me because I spend a lot of time talking about ETFs and I spend a lot of time on Twitter. So this is another set of funds that was kind of memed into existence. It's been a running joke on Twitter for a long time that someone should create ETFs that track Jim Cramer's picks, and those actually finally arrived. They launched this week. It's a pair of ETFs. You have the Inverse Cramer Tracker, which, as you can guess, it shorts his picks and then he buys companies that he recommends against. And then on the other side, you have the Long Cramer Tracker ETF. So that's basically going to back the shares that he likes and then ditch the ones that he doesn't. So it's a way that you can trade alongside, either with or against Jim Cramer. And I think it's really interesting. The way this portfolio comes together is the portfolio manager behind it and his two other partners, they just watch TV all day. It sounds like a great job.
So basically, they just watch Mad Money and then put it in the ETF. Why can't people just do that for themselves?
It's a lot of work, actually. This is like an extreme example of an actively managed fund. It has an extremely high turnover rate. Because of that, it does have a pretty high expense ratio, like 1.2%. But they watch him in the morning, they watch him in the evening, and they watch his Twitter all day. So, I don't know. Sounds kind of fun.
Has there been any back testing?
Has there been any back testing? That is unclear. Apparently, they've had, some paper trades going on since January. Unclear how those have performed. So I don't know if this should necessarily be the core of your portfolio, but it is fun.
I guess you just have to go and watch old episodes if you wanted to do that. It would be interesting to know whether there is actually a kind of a paper trail surrounding all of this. So it might be more tricky to do than with a normal product. Anyway, Katie, great stuff as ever. Fantastic. Katie Greifeld joining us on what's happening in ETF land. Of course, you can catch Katie and all the latest ETF news. It's all available on ETF IQ Monday, 1 p.m. New York time. It's fantastic. This is Bloomberg. So it seems you have a little bit of a duration mismatch in markets at the moment. Equity markets are focused on the here and now because the data in the here and now are good. The earnings story in the here and now, actually not too bad either. European stocks are up by around 0.8% right now. Take a look at what Volkswagen is doing. This is Europe's biggest car company. It's out with earnings. It dropped them a little bit earlier. The stock has bounced very strongly on the back of it. It's basically saying it's going to have a great year in terms of revenues because it's going to sell all the cars that it couldn't sell previously because of the pandemic, because of supply chain issues, etc., etc. It's got a huge order book and it's going to sell those cars, and that's going to drive revenue. And the auto sector is outperforming. Technology is doing well on Broadcom as well. Again, similar story. The here and now doesn't look too bad. Volkswagen is saying that the here and now doesn't look too bad, and it's going to get even better. The services data out of Europe today ticking higher too. All of that seems to be the narrative that the equity market is latching onto. It is not latching onto higher rates. Rates are at kind of standstill today, but it has been the worst week for the German Bund since the beginning of the year. We've seen yields climbing really quite sharply. Is there more to come is the big question. We're at 2.739. Brent crude has recovered its poise. Energy stocks that are not having a good day. Brent back up around 0.3%. Coming up on the European close, we will get Laura Cooper's take on what is happening here. Senior investment strategist at BlackRock. Always great to chat to her. She's coming up next. The close is also coming up. This is Bloomberg.